Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Friday, June 20th, 2025. Today's episode begins with our first headline. Leading economic index hits 10-year low in May plus April. Leading economic index negative revision. On first glance, May ticking down by only 0.1% doesn't seem all that bad, except for the fact that April was revised down another 0.4%. So this 0.1% literally doesn't look as bad because they literally just moved the goalpost. If they didn't revise April down another 0.4%, then the May rating of this would have been negative 0.5%. Every month since middle of 2022, the leading index has been falling. Typically, after it falls, the coincident index falls afterward. And when that's falling, that's when you know for certain we are in a recession for certain. And that hasn't happened yet. The black line still going up a little bit, and the blue line still going down. This chart represents a large part of my own thesis that we are indeed headed into a recession, or worse. The main reason that it went down only as much as it did was actually because with all of the volatility in the stock market in April, May, the stock market recovered. And so a piece of the leading economic index is the S&P 500 itself, adding some positive weight to this index, while most other things are not looking very strong, especially the worst of it all is the consumer expectations for business conditions. Which leads us to the next headline, the Philadelphia Manufacturing Survey, another weak one coming out. This is a survey put out by the Philadelphia Fed, and the main highlights are new orders and shipments were not too terrible, however, still below their non-recession averages, so lower than average good times. And then the other notable piece here is that the employment index turned negative and fell to its lowest value since May of 2020. Similar to the New York manufacturing data that came out, I think it was last week, the manufacturers are optimistic. I think as optimistic as they can be. One piece of this is this question here: over the next 3 months, how do you expect the impacts of the following factors as constraints on capacity utilization to change? In other words, these things over here, how are these going to affect your business? Are they going to get worse? Are they going to stay the same, or are they going to improve? So the majority of the weight of this is the expectation for things to stay the same, at least for now. I say this is optimistic because overall the diffusion index, the main number that we get out of this report, is -4. So things have been getting worse, but expected to stay the same. Report after report is not showing a resilient, growing, booming economy. Quite the opposite. Moving on. Third headline, triple witching, highest option expiration in history. Option contracts, which are, if we're going to be honest, they're essentially lottery tickets on betting if the stock markets, or if stocks and bonds or whatever is going to go up and down. Today we had a triple witching day, which means that various types of contracts, not just the options contracts, but also futures contracts, expired today in record fashion with an underlying value of $6.5 trillion. So the 6.5 trillion represents the amount of, when you purchase an option contract, let's say you pay $100 for the contract, that $100 contract can represent like $10,000 worth of stock. So, the $10,000 is just the underlying part of it. So, there's not actually $6.5 trillion involved. It's just the underlying amount, but still largest in history. And days like these are when the institutions make sure that those lottery tickets that they sold to everybody become as worthless as possible. They make sure that they win the game with those options contracts. And that's largely what controlled a lot of markets today. Fourth headline today, Waller says possible July Fed funds rate cut. Like CNBC says right here, and other headlines you may have caught. It says that exactly right there. And I believe it was that alone that got the Fed funds futures to change a little bit. Yesterday's probability, or I guess this would be Wednesday's probability of one cut, was only 8.6%, now almost doubling to 15% today. You know, notably, a week ago it was 21%, by the way. So these things really do just flop all around. But the idea of a potential cut in July got markets to open a little higher, but then they sort of sold off, and not much moved a whole lot today. There's some charts I want to go over momentarily. Before we get there, community topics. What moves, if any, did you make today? Did you buy anything? Did you sell anything on this triple witching day? Did any of your options contracts become worthless? Robschild sits on hands. I didn't have anything expiring today myself either. Another community topic I wanted to bring up. Verified Investing is another YouTube channel. It's one that I follow. It's with Gareth Soloway and a whole team of people. He's doing something really cool on Monday that I hope that I can be a part of. I may not be able to watch it because of certain, let's call it civic duties. You probably know what that means. Anyhow, if you have time to do it and you're watching this show, I recommend trying to get in on it. It's Monday, it's during the work day, so not everybody can do it, but you know, maybe if you can catch it's Gareth Soloway for free. You get to watch him trade live, and so I'm hoping that I'll be able to watch it, but we'll see. Anyway, coming up, continuous tariff updates, like, you know, all this stuff going on in the world, all this stuff in politics, all these headlines. It's like Mr. Market forgot about the tariffs. Like, that's just not a thing anymore, you know? Who cares that they're getting unpaused in about 2 weeks from now? You know, I mean, that's the initial announcement is what crashed the S&P 500 like 20% within, what was it, a week or two? And now they're becoming unpaused, and it's just, everything's fine. Mr. Market forgot about it. It's like, you know, I always like to talk about Mr. Market driving a car down the highway, being this crazy guy. It's almost like his brakes just like broke and fell off onto the highway, and he's just driving, and like he got worried for a little bit, but now he just forgot that his brakes are gone. That's kind of the way that I'm looking at what the feeling of what Mr. Market's, how he's acting like lately, in my opinion. But remember, guys, I'm just a guy with a crystal ball. And then, of course, coming up still also federal budget updates. We still have to see, you know, what is the federal government going to do with their spending moving forward. And then also the Iran-Israel conflict war. Some people are referring to today being another taco trade day. Trump always chickens out. That's the phrase. Because he says, oh yeah, we're going to get involved with the Iran thing, and then what does he do? Pause button for 2 weeks. I'm sure you saw in the news. So that's where we're at now. I mean, I imagine he can change his mind at any point if it comes to it. But continuous updates with that. I mean, it has the actual potential to, you know, lead to some kind of like a much bigger conflict. Let's say China and Russia get involved and the U.S. get involved, and, you know, all of a sudden, I mean, there is a potential for World War III to be breaking out here. So, you know, anyway, very important to keep a close eye on what's going on with that. As always, thank you for watching, subscribing, commenting, and supporting. I'm like 34 subscribers away from 1,000 subscribers, a huge goalpost for the Robschild community, the Robschild channel. Your support, comments, and subscriptions are much appreciated. No changes to the daily reminders macro view. See my website for an explanation. No changes to the crystal ball ratings nor the Robschild portfolio. On to the chart, starting with the SPX, the S&P 500 dropping 0.2%. Like I said, we opened actually higher, and it looks like we might be going up, and then we were dipping, and we closed exactly at the spot where the institutions are going to make sure all those lottery tickets they sold expire worthless at 59.6785. TLT, my favorite place to be, losing 0.18% today with a green candle, so we had some buyers step in, but we're still in this blue channel. I'm kind of wondering how long we're going to be in this thing. Is this just we've been in this channel for quite a while now. Are we just going to stay in it forever? I don't know. Next chart that really caught my eye today was HYG divided by SHI. This represents from yesterday to today if credit spreads are like loosening or tightening, and we tightened today. We are getting tighter in credit spreads. People are willing to buy junk bonds. I think it's complacent. I think it's too risky for what it is. But it acts as support for stocks. Stocks can go higher in an environment where credit spreads are tightening. So I don't expect this to last, but as long as it is lasting, perhaps the stock market has another leg to the upside is a possibility. I mean, personally, I lost trust in Mr. Market a long time ago when we started getting the Cape-Shiller ratio over 30 and then 32 and then 35. And I think we hit 39 at one point. Now we're still around 37, 38. So, I mean, I think he lost his mind a long time ago, but, you know, anybody's guess what he'll do next. Crude oil, still in a nervous, precarious position. We are at $73.99 dollars a barrel currently. You know, we're nowhere near even like, look at how expensive crude oil was getting in 2022, peaking the very peak around 130. You know, I would think with this much risk of this stuff going on in the Middle East that crude oil would be much higher. This market is surprisingly low. But it's the kind of market that as long as they're producing and people are consuming it, it's like it's one of these markets that that can't foresee the future. It has to deal with what's going on right now. That's again why it was able to go to negative $32 a barrel at the bottom of COVID. It wasn't like what is oil going to cost, it's what is oil right now. But even so, I am surprised that crude oil is not a little higher than this. I found it interesting that Bitcoin, Fartcoin, where are you? There you are. Down 5% right now. Earlier it was down a bit further, 10%. And total crypto minus Bitcoin also dropping to 1.11 trillion total market cap. We were recently at 1.27 trillion. So yeah, all crypto kind of getting a little bit of a hit right now. My guess is it has a little to do with the stable coins attached to the dollar. I believe JP Morgan's getting involved with that. And so, I mean, if you can get crypto that's tied to the dollar, then what's the point of any of the other crypto? Since, you know, everybody's debt is in dollars, and dollars is actually what people want in the end, and that's how we price things, is actually in dollars. There's not as much need for any crypto, so it all went down today is sort of what I'm getting. Next chart that caught my eye today, the triple Qs. This is the NASDAQ. We have an engulfing red candle the last 2 days, plus looking like we're rolling over here. This looks bearish more than anything, and although we don't have such a bearish pattern looking like that in the S&P 500, tech and like semiconductors too can lead the way down, almost engulfing 3 days in SMH, the semiconductor industry, but fully engulfing the last 2 days. So are we topping out here? Are we following Bitcoin to the downside as the stock market has done in the past? I don't know. Other things to look forward to, by the way, for next week, we have flash PMIs. That's one of the bigger ones. Of course, initial jobless claims, which every week I'm going to keep saying I am like just waiting on the edge of my seat for one of these reports to really start cracking. We are elevated. It seems to be going up and up, but I guess don't count your chickens before they hatch. Or anywho, GDP second revision of Q1. Remember, the first revision, we have negative 0.2%. It's expected, I'm sure, to be negative. We'll see if it's more negative. That would be interesting. And Friday, PCE. This is the Fed favorite gauge of inflation as far as, what do people have to pay for stuff? Is this in control? Is it going up? Is it going down? I mean, this might be the report that Waller is seeing ahead of time. If this is negative, it's going to give the Fed, the ability to cut, even though they sort of don't want to, because they're like, oh, well, the tariffs are going to raise prices. And so they seem way more hawkish than I think they've been in decades at this point. And on purpose, they know that inflation can be achieved, and so they're not worried about not being able to achieve inflation anymore. And so that's the tilt. That's like, that's the tilt that gets them, from my perspective, to be in the part that's like, they were always leaning on the dovish side, I think, for like the past 20 years. And I think because of this last wave of inflation, personally, we're going to be tilting the other way. And I think the consequence is actually going to be a lot harder and stronger than anyone else out there expects. But, that's just a crystal ball rating. And that's all for me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.